In light of the Silicon Valley Bank and now the Signature Bank collapsing, many people are wondering, is their bank next? And it has many people wondering if they should be pulling their money or moving their money somewhere else. If you're not fully caught up with the news and what the story is behind the Silicon Valley Bank, here's just a couple of bullet points. Last week on Wednesday, the bank notified its investors that they needed to raise $2.25 billion, and that's billion with a B, not million. So a lot of money. They needed to raise this to shore up their balance sheet. That phrase right there sent everyone into a panic. That resulted in depositors making a run on the bank to the tune of $42 billion. That's a lot of money, as you might imagine. Now, there's some people that still have their money there, and the FDIC insures accounts up to $250,000, but many people had more than $250,000 sitting in their bank account. The Treasury Department was at work over the weekend trying to figure out a solution to protect the depositors of these banks that have failed. And they are making good on it. They have said that not only will the FDIC cover up to the 250, but they're also going to make sure that anybody who had over 250,000 is reimbursed or their funds are restored to them through some other measures that they're taking. Now, let's take a look at Silicon Valley Bank. They are a massive bank, and most of their dealings were with venture capital lending to the tech industry. So you may think, okay, well, tech's in trouble, so that probably had something to do with it. And maybe it did. What is hurting banks right now is that when interest rates were really low, they were buying up US Treasuries. So those US Treasuries typically are a low risk instrument, but now we've had this rapid increase in interest rates. So those Treasuries are pretty much worthless, which means the balance sheets of banks are getting a big ding. While there are some banks that are on a short list of banks that may have some potential challenges ahead, mostly what we're seeing is most banks are stable and there is no reason to panic. It all circles back to the question, is my money safe? Should I consider moving it? So let's look at a couple of things. Number one, the FDIC is insuring depositors up to $250,000. So that's your backstop. If you have more money than that, then God bless you. And you may want to look at moving your money, some of your money, into a different investment vehicle, perhaps a credit union or something of that nature. So now you've got your money separated and you've mitigated potential risk. So that's one point. Then the other piece is the fact that the Federal Reserve and the Treasury and the FDIC and other government entities are coming together to see what can be done to shore things up even stronger to protect us depositors. So that's the second piece. And then the third is most banks most likely will not fall into this murky water of having some issues with honoring their depositors. So what should you do? Take a look at where your money is. Take a look at the institution and not only their history, but how are they capitalized? How are they leveraged? How strong and secure are they? Are they on that list, which is a short list of banks that could see some trouble on the horizon? So do the analysis of your situation to make the decision. Whatever you do, though, don't make the decision based on fear and panic. Seek out some guidance locally with your financial planner. Go talk to your bank and get some quality information before you make a decision of moving your money.